Hello, everybody. Welcome to VRIC Media, your most trusted voice in metals and mining. My name is Jesse Day. Today is December 11th, 2025, and we are bringing the VRIC to you with our series of expert online panels. Today, we have Rick Rule, CEO of Rule Investment Media, and Lobo Tiggre, founder and publisher of The Independent Speculator, back for another round. Gentlemen, I am delighted to have you back on the show to discuss the commodity sector today.
It's always fun.
I think speaking for both of us, our pleasure, sir.
Excellent. Well, we got to kick things off with discussing silver, of course, the metal now soaring past $63 an ounce, with many analysts forecasting triple-digit prices in 2026. Now, although the mainstream media hasn't really been singing silver's praises at all yet to this point, it does feel like the euphoria online, on social media, is perhaps getting a little overheated, and it's often when everyone sees something as a foregone conclusion that Mr. Market changes his tune. Do you think some caution is warranted here, or are the calls for triple-digit silver justified? Of course, we have to go to Darth Silver, Mr. Lobo Tiggre, first for his thoughts.
Yeah, I don't have my Darth mask handy here, but so okay, I'll stick my paw in the fire here and do a little raining on the parade. But let me push back on the question. As we speak, CNBC changed its previous Devil's Medal report on silver, which to have CNBC even cover silver at all was extraordinary last week, let alone a 10-minute video. Okay, they called it the Devil's Medal. This week, it's the Sleeping Beauty Medal. And CNBC's talking triple-digit silver. So as a contrarian, I got to say, my contrarian wolf whiskers are twitching, you know. But more seriously, you know, even the most diehard silver bull will tell you that silver lags gold at first, and then more than catches up at the end. And I have been comforting myself by looking at the charts and looking at the numbers and saying it hasn't caught up yet. And if you look at the inflation-adjusted peaks, it still hasn't caught up. But I'm not sure that looking at the peaks is the right way to look at it. If you look at gains, well, where do gains come from? Not from peaks, they come from bottoms. If you look at the bottom in late 2015, silver has caught up to gold now. It has more than caught up to gold right now on that bottom on a percent gain basis. It hasn't soared way ahead, but it has more than caught up. And today, it's certainly rising faster than gold, something like 3 to 4x higher. It's a 1% up on gold, 3 or 4% higher on silver. If that suggests that we're in that catch up with gold phase at the end of the market, you know, you can't ignore the at the end of the market part of that whole thesis. I'm not saying this is the case. Put away your rotten tomatoes, dear silver bulls. But I'm just saying, A, be careful what you wish for, and B, don't ignore the data here. Like, you can be as bullish as you want, believe in triple-digit silver. Yes, I know that inflation adjusted, the peak is over $200. But, you know, silver is screaming north right now. And you yourselves have talked about what that means in the past. So you don't get to ignore that now that it's happening. And the big question is, you know, is this the blow off top, or is this an adjustment? And Rick's former employers over there put out a report, and they're saying it's due to the supply side. And there's real supply constraints going on. I don't have access to the math on this, but I know that copper mines produce more silver than even gold mines. The number one single source of silver is copper. There have been 4 major disruptions in the copper space in 2025. I don't know what that does to the silver supply, but it has to do something. So this is my bull thesis here. Like, there are legitimate reasons to think that silver screaming north right now is not the blow off top of this bull market. It has to do with silver supply. And if so, that's extremely bullish going forward for both monetary metals.
Yeah, great comments there, particularly on the silver as a byproduct of copper accounting for so much and all the difficulties being faced in the copper mining sector. Rick, when silver was in the $20 to $30 range, you often talked about how you loved how much silver was hated. Now, here we are at $63. Obviously, it doesn't seem like it's hated at all anymore. Would you be exercising caution at these prices, or do you think there's plenty of upside ahead?
Well, I'm on record 8 weeks ago as having been a seller. The truth is that the easiest money is the hate trade. You buy something that you believe there will be ongoing demand for over 5 or 10 years that is priced low, particularly relative to production cost, and we can talk about that in silver later. As Lobo said, primary silver mines generate between 18 to 20% of supply, so that thesis is tough there. But the truth is, the reversal of the hate trade is the easiest money for a speculator to make. Most so-called speculators, which is a different way of saying most losers, can't participate in the hate trade because they require the validation that comes from price movement to validate the narrative. And by the time that's occurred, the narrative, the value of the narrative has been cut in half by price appreciation. The second thing is that most speculators, and I know this now from grading almost 100,000 portfolios in 35 years, most speculators that get the strategy right get the tactics wrong. They speculate in a print that will take 4 or 5 years to work, and they have trauma holding position over a long weekend. When the juxtaposition between your strategy and your tactic is that cattywampus, the probability that you make money is really close to nil, really, truly close to nil. People aren't going to want to hear that. You know, what people who listen to these channels want to hear is silver's going to the moon. They don't want to have to question the narrative themselves. They don't want to have to believe they're taking risks. They want to take the credit for their success, and they want to assign the blame to Lobo Tiggre and Rick Rule. Fine with me. I will continue to trade against their prejudice. The hate trade's out of silver. I need to say, personally, silver represents about 2% of my bullion holdings. I own bullion out of fear. I save in gold. I maintain liquidity in currencies. And that part of my savings, which are in bullion, are 98% gold. I speculate in silver stocks, which are even more volatile than silver. So, you know, for me, in a sense, the question now that silver is no longer hated is an irrelevancy.
Well, let's talk about the silver mining sector. I know that's one that both of you follow closely. Lobo, give us your thoughts at present, because obviously this is a much smaller handful of equities than one has access to with gold. And as you mentioned, a lot of silver is mined as a byproduct. How are you currently viewing the silver mining sector? Obviously, a lot of these stocks have risen dramatically along with the silver price. Is there still opportunity there in your view?
Well, since I'm saying that I don't think we're in the blow off top phase, then almost by definition, that means there has to be some opportunity. Am I buying silver right now? Is it screaming north or silver stocks? No. My last two purchases were uranium stocks that were down, not silver stocks that were up. That said, if I'm right that we're not in the blow off top phase, the supply issues do get sorted out at some point. Those other secondary supplies come back online, and then we get a bit of a, which I think would be healthier for the overall market, for the longevity. You know, if you're in this for the debasement trade, why on earth should we have a blow off top right now? When, you know, are the governments stopping to print money? Right? No, of course not. So a healthy breather and a correction, I think, would be an absolute gift for anybody that isn't long silver already. I'm long, like I can't lose on this. I'm long and I've taken profits, as Rick likes to say, sail beyond the point of no concern, right? So, it's challenging to try to put more risk on top of a risk-free position when you can't lose. But if you missed it, then that healthy correction and consolidation would be, a spectacular opportunity rather than, chasing things at all-time highs. So that's my default. But if, for all the people who are mad at me, no, silver's going to the moon. Okay, if you really believe that, if you're absolutely convinced, I'm not telling you to do this, but if that's what you think, the way to play that is to pile into the go-to names, as Doug Casey likes to say in the space, to buy the biggest, most well-knowns. For all the Johnny-come-latelys who just heard about silver for the first time on CNBC, and Kramer hasn't jumped in yet, so that's okay. Where are they going to go? They're going to Google silver miner, right? And what are they going to find? I don't need to give you the names. You know who they are. So that if we're in that blow off phase, that last bit, that vertical leap is still ahead of us. And the go-to names, the big, most easily findable producers are the way to speculate on them. I wouldn't say gamble on that. So that's as close as I come to giving a stock pick. There are very few in that space, so you know who I'm talking about. If you believe that, that's the way to play what happens next. Me, I'm looking for a pullback.
And Rick, what about your strategy when it comes to investing in the silver mining sector?
Well, the lower quality silver names are stupidly overpriced. The people who have silver merely as a component of the name on the share certificate, you need to understand there's probably 100 silver stocks out there that don't have any silver. And if the price of something that you don't have any of goes up, it shouldn't have any impact on your material value. It does have an impact on your ability to get even dumber people on your register. And the industry likes dumb money. By the way, the institutional investors often qualify as dumb money. There were $1 billion in silver bonds sold over the last 2 weeks. I looked at every issue closely, and I couldn't find, never mind a compelling reason, I couldn't find a reason to buy any of them. It is interesting to see First Majestic Silver with a lower cost of capital than Codelco. And by the way, I'm a Keith Neumeyer fan. He's a friend of mine. He's made me a lot of money. I'm not criticizing First Majestic Silver. If $300 million was offered to me on those terms, I would have tried to upsize to $2 billion. I'm just questioning the sanity of the people who bought them. But as Lobo says, I believe that the dollar debasement trade has 10 years to run. I note that in the last 10-year run we had in precious metals markets, actually an 11-year run, despite the fact that the metals prices rose by a quantum, if my memory serves me well, 3 times during that run, the metals markets fell by 30% or more. And once in 1975, the metals fell by half. So people who intend to play the debasement trade need to watch Pro Rodeo on a Saturday. They need to understand that they will be thrown from a bull. And it ain't going to be pretty. And they need to be psychologically and financially prepared to sit through or buy through 2 or 3 35% declines and perhaps 150% decline. Most speculators that I know, most would-be speculators, actually Lobo did a great job of characterizing them as gamblers as opposed to speculators. People who think that attending casinos is an investment strategy. Most of those people, I don't think, have the intellectual fortitude to be classified as speculators. I'm not saying they're bad people. They have lives, they have families, all that kind of cool stuff. They're greedy, all good, all good. But I think all those people, and we could have this conversation about silver, about uranium, about tech stocks, about whatever. Most of them need to understand that the greatest risk that they face in their portfolio is located to the left of their right ear, to the right of their left ear. It's all about themselves. And silver is no different. I would note in the equities that there is, as Lobo suggests, a paucity of opportunities. On the speculative side, I see 5 or 6 names. On the investment side, I see 5 or 6 names, and I can find big warts on all of them. There is no brainer, no brainer out there. There's absolutely no brainer. We are right now in the part of the market where, ironically, the least efficient producers will do the best. Guys that have the best in the market. I don't mean they'll be the best performers. If you are a $20 an ounce producer in a $40 market, you're enjoying a 50% gross margin. If you're a $40 producer in a $40 market, you're enjoying no margin. In a $60 margin, in a $60 market, the $40 producer, the $20 producer has seen his margins double. The $40 producer in a $60 market has seen his margins go up infinitely. And so what you see in this market is companies that offer leverage to silver will do the best in the near term among speculators. They're also the ones with the greatest risk. So people need to take that into account. Names that have underperformed for 2 or 3 or 4 decades that have abysmal track records with regards to capital allocation that are fairly large but high cost producers will scream in this market. And I guess if a speculator has the willingness and the discipline and the understanding to take that risk and be ready to sell in a nanosecond, that is to say, if he or she doesn't have a life and they can watch the screen all the time, there's great opportunities there. For myself, speculating is about probabilities. And it's about the juxtaposition between risk and reward. And so I see myself as opportunity constrained in the silver space.
Timing is everything in this business. We've seen commodity prices really move up. The copper price, that started to move up strongly. We're not far off all-time highs, although you wouldn't know it from the junior sector and copper companies in general. But I think over the next year or two, we're going to see that really correct to the upside, and you're going to see a lot of money come into the sectors. Vizsla Copper, we're the team that brought you successes, including ISO Energy and Vizsla Silver. If you want to learn more, you can find us at vizslacopper.com.
Well, some great thoughts from both of you. I feel like you're giving everybody a wake-up call here today. So let's provide a bit of a wake-up call on the gold sector as well. Obviously sharing a lot of characteristics when it comes to silver as a monetary metal, doesn't have an industrial component, but we've heard some very big prices being thrown around for gold as well. On the lower side, I talked to Steve Hanke on this program. He said he thinks it's going to 6,000 this cycle, up to Jim Rickards, who I spoke to a few months ago. He said it's going to $23,000 an ounce. Now, I know both of you do not do the price prediction game, which is why I love talking to both of you. But I'd love your thoughts on where you see the gold sector headed, and perhaps the gold mining space as well, Lobo.
Here's how I look at this. A, nobody knows. Point. Just period. Nobody knows. B, the cheerleaders that tell you it's going to the moon, they get more clicks, and we're probably, between the two of us, we're being a two-headed voice of reason hydra monster for your ratings, Jesse. I don't know that we're helping you here. But irrational exuberance is a risk for a reason, right? So just beware. Just beware. That having been said, let's say you listen to some, not us, but some other irrational exuberance, promoter in 2011, and you actually top ticked gold in September of 2011, just over 1,900 an ounce. Well, you've actually doubled your money since then. So if you listen to what Rick just said about having greater patience than a long weekend, like if you believed in the debasement trade, if you had confidence in why did I bother buying this shiny pet rock, right? And you weathered the storm, you came out actually ahead. And even not just the metal itself, but the stocks. If you bought the best of, you're actually substantially in the black. Like those best of, again, I don't need to name names. They're hitting all-time highs. So you've been made whole not only on the commodity itself, you've made money, substantial amount of money if you bought the commodity, even if you top ticked it last time. And you've made money on the stocks. So if Rick and I got careless and encouraged anybody to go out and buy the peak today, and that turns out to be the peak for this cycle before another big, Rick mentioned 30 to 50% drawdowns. The drawdown after that 2011 peak was almost 50% for gold. It's like, if that's the worst case scenario, that's what's ahead of us. As long as you understand why you bought it and you don't get shaken out, then the track record is that you will come out ahead eventually. Now, it might take years, right? I mean, 14 years to wait to come, to be made whole after 2011 is a long time. But the fact is that it happened. And I'm not saying that anybody has to wait 14 years for payday. I'm saying if the worst case scenario is that we've just peaked, like today, silver 63, 64 bucks, gold 42 and change, that's the top, like 2011 all over again, and we're looking at a 50% haircut. If that's the worst, that is actually survivable. Not only survivable, you can make money by A, holding on, and B, buying the dip. Like if you bought the peak in 2011 and had the absolute courage of convictions to buy the low in 2015, you would be on a lot of money, gains, not just made whole, but you would have made a lot of money by having the courage of your convictions there. So if that's the worst case scenario, I don't feel too alarmed by saying, yes, my base case is bullish. I do think gold goes higher. I don't have a price projection. I'm happy if I just get the direction right. So all of that having been said, similarly with silver, it's just, I don't know if it's like genetic or something. I just can't buy something at an all-time high. So I'm waiting for volatility. There's always some next scare or something, maybe some announcement from the current administration in the United States, that never produces any market volatility, right? Or, some AI trade scare or something puts a big scare in the market. There's a liquidity event. Like if the AI bubble pops, that really doesn't have anything to do with gold. But it's such a huge part of the market right now that going into reverse creates a liquidity event that puts everything on sale, even gold, as we saw in 2020 or 2008, or Rick can talk about 1987. Sorry, I can't. So personally, what I'm doing is I'm long, so it's easy for me to say, but I am looking for dips in market. As Doug would say, Doug Casey, I'm waiting for volatility to be my friend in the space. But don't confuse that. That doesn't mean that I'm bearish. I'm ultimately bullish. And if I didn't own any today, I would buy. And if, like I started out saying, if the worst case scenario is I might have to be patient and have the conviction of my trade to make money on it.
And Rick, what about your approach at present to the gold sector? Do you have a similar aversion to buying gold at an all-time high as Lobo does? Same question
Gold
for the
stocks.
mining
gold
stocks
isn't
as
at an
well.
all-time high at the moment, just the stocks.
Yes. What are your thoughts there, Rick?
Absolutely not. I have been saving in gold and maintaining liquidity in primarily US dollars since the year 2000. I sort of reorganized my mind and my financial thinking in the millennium, and I decided to save in gold. And by the way, 2010, when the value, or 2011, the gold holdings in my portfolio fell precipitously. That coincided with the rest of my portfolio doing very well. So gold did its job for me. If you have saved in gold like I have, sadly, I still think in US dollars. I haven't, although I keep an alternative ledger in gold, psychologically, I still think in US dollars. But when I look at my savings in gold and I look at the price levels of various items against the value of my gold, I'm struck by how cheap housing is. I'm struck by how cheap gasoline is. I'm struck by how cheap healthcare is. When I look at the US dollar side of my ledger, I'm struck by how expensive all those things are. That's really an interesting circumstance. I think, I haven't done the calculation recently, but I think gold since the year 2000, and by the way, I didn't buy all my gold in 2000, I bought it consistently along the way. I think gold has generated a 9% internal rate of return compounded for 25 years, which is to say it's done its job. I've had a lot of interesting discussions with large gold holders recently as a consequence of going into the business of lending money against physical gold. And I was struck by a conversation that I had with a European family office in Switzerland about 3 weeks ago. I think they got it exactly right. They said they continue to buy gold in hopes that it goes down. Because gold for them is a store of wealth and insurance against other asset classes that they are already represented in. With regards to your earlier comment about gold price forecasting, I've decided over 50 years that price forecasters are headline seekers. I have never known anybody whose track record with regards to price forecasting had any measurable degree of success, ever, 50 years of watching that. With regards to gold, I have a very, very, very loose model. It is my belief that because of negative real interest rates, which is to say the yield on the US 10-year Treasury, relative to the rate of depreciation that I see in the US dollar, which is not the CPI, by the way, I think rates to savers are negative by about 380 or 400 basis points, which means that most savings products, long-term savings products in particular, are financial suicide. I believe, and I could be way, 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 way wrong, but I believe the US dollar likely loses 75% of its purchasing power over 10 years. That's my model. And I believe that the nominal price of gold, which is to say the US dollar quote for gold, not its value in goods and services, but the nominal quote in gold, likely mirrors the decline in the purchasing power of the US dollar. So internally, I'm believing over 10 years, the gold price is up in nominal terms, US dollar terms, between 250 and 400%. I'm prepared to be wrong by 50%.
I'd love to talk about platinum and palladium for a moment here, because as everyone has been paying attention to gold and silver, those metals have been quietly breaking out as well. Platinum up approximately 80% and palladium around 65% year to date. I wonder if you are watching, paying attention to these metals. Obviously, their characteristics are very different than gold and silver in that they are purely industrial commodities. What are your thoughts on platinum and palladium right now, Lobo?
I do see them as poor man's gold 2.0 and 3.0. Like if silver is the poor man's gold, if you get the debasement trade and you're excited and you want to participate, but you look at gold not just at nominal all-time highs, but at least using the CPI, not Rick's real number, whatever that is, but using the CPI, we've hit real all-time highs in gold. So you get the thesis and you want to participate, but like me, you have a hard time buying an all-time high. You look, well, silver's not there yet. Well, but that's gone up. So, well, platinum and palladium, platinum's rarer than gold, but cheaper than gold. That looks like an opportunity. It's certainly not a surge in auto sales that have suddenly, increased demand for catalytic converters. So that's my brief take. Is I do see it as versions of the poor man's gold play. And so as long as you're bullish on gold and they remain relatively discounted, there's a case to be made there. But if gold catches a sniffle, they'll catch a flu, would be my way of putting it.
And but before I go over to you, Rick, if you were looking for exposure in that sector, Lobo, where would you be looking? Because obviously there's very few mining equities, most of them located in South Africa. There's physical metal, obviously. There's the physical platinum ETF from Sprott. Where would you be looking to get exposure in that sector?
Yeah, obviously something that's a surrogate. Well, you could buy the metals themselves, but actually I'm not a fan of that, because you put an ounce of platinum in my hand and an ounce of palladium and an ounce of silver. I might be able to tell the silver, but I'm not sure. But the thing is, nobody's going to try to sneakily give me an ounce of platinum instead of an ounce of silver, right? The other way around, not so much. So if the idea of owning bullion is savings in a rainy day fund, and I'm going to take my palladium down to the pawn shop because I need money in an emergency, and they can't tell it, and it turns out, oh, guess what? That's not palladium, that's silver. I don't have an assay lab at home, so no, I don't like them as savings vehicles. As speculative vehicles, the names are pretty obvious. The ETFs are a great way to just bet on the metals themselves, low fee. The miners add risk, as you say, but note that there are other companies that have, I don't want to give away anything too much here. Sorry, clients pay me to pick stocks, so I try not to give away stock picks for free. And by the way, dear internet watchers, if it's for free, remember, you are the product. But let's just say there are other companies that have PGM linings, so you get some benefit of exposure to PGMs without having to really risk too much on just the PGMs themselves. I like that as a way to gain exposure.
Rick, your thoughts on platinum and palladium?
Yeah, I want to take issue with your first statement. In several parts of the world, some of which I used to travel to and sell to, Korea, Taiwan, China, and Japan, platinum isn't viewed as purely an industrial material. It is valued as jewelry and iconography, and in some areas as investment in money. So I need you to say that. I was unaware of the attraction that platinum had in Far East Asian societies until I traveled there. And that realization traveling there was part of the reason that Sprott originated the physical platinum and palladium trust. It was an eye-opener to me. I do not own platinum or palladium bullion. I have a small position in the Sprott Physical Platinum and Palladium Trust that I strapped on when it was, again, hated, but hated to the extent that the market clearing price of platinum and palladium was substantially below the total cost of production. That's a wonderful thesis of mine. I like to find commodities where the industry is literally in liquidation, where the need for the commodity in the material economy of humankind guarantees that the price goes up. And we were there in platinum and palladium 4 years ago. There was two choices: the price would go up, or smog would become an overwhelming problem. It had to happen. That preference was better expressed in the equities, but there were precious few PGM equities that I could buy that didn't have warts that, in my opinion, overshadowed their attractiveness. My biggest PGM position was Norilsk, which treated me extraordinarily well for 24 years until it didn't. Now, if I look at the performance of my Norilsk over 24 years, I can't really complain about what happened at the end, but I do anyway. Sibanye Stillwater, the CEO, has been a friend of mine for 35 years. And the challenges that they faced with regards to South African politics and culture precluded me buying what is probably, after Norilsk, the preeminent platinum and palladium producer in the world. And some of the other names were just too small. As Lobo says, I've bought platinum and drag in the equity markets. Ivanhoe is opening the world's largest platinum mine fairly soon. Mokopane in Anglo-Platts is not an unattractive asset. But again, you have South Africa and political risk. So I've been sort of struck expressing my equities preference in much lower market cap, much more speculative names. Things are really exploration development companies in a platinum wrapper. I do believe that from a speculative point of view, platinum and palladium, in terms of the equities and the metal itself, are perhaps more attractive than gold and silver. The reason for that is on the supply side. 80% of worldwide platinum production, ex-recycling, actually more than 80%, comes from three countries: South Africa, Zimbabwe, and Russia. I often say that there's real threat of political and social risk in any of the three of them. That's wrong. There's a guarantee. We're experiencing that in Russia today. And I think one of the reasons that we have seen such low PGM prices is the fact that the Russians need money. They're busy fighting a war. The last time they needed money, in the early part of the decade of the 90s, that coincided with a low in PGM prices. The Russians cleaned the shelf. And two things happen when they clean the shelf. When it's clean, there's no more selling pressure, and the Russians defer sustaining capital when they need the money either to stay in power or murder Ukrainians. My suspicion is, at the end of this conflict, that Norilsk's, Nornickel's ability to continue to produce platinum and palladium for the lowest AISC in the world will be over for 3 or 4 years. They will need to restore their mines, the mines that are currently being cannibalized. So if I looked at a metal purely for its speculative potential, the possibility exists that if there were a political and societal semi-collapse in South Africa, not a bad bet. not a guarantee, or a political or societal collapse in Russia. Again, not a horrible bet, unlikely, but not a horrible bet. What you would see is platinum and palladium prices soaring. Please do not use a headline that says Rick Rule says platinum and palladium prices will soar. But the truth is that the utility generated by platinum and palladium in the fabrication process is so absurd that the demand is effectively price inelastic. It takes $125 worth of PGMs to install a catalytic converter that enables the sale of a car for somewhere between $50,000 and $100,000. If the price of platinum and palladium doubled, it wouldn't impact the sticker price of that car one iota. Now, understand, I'm not saying that we're going to have that supply shortage, but speculation is all about probabilities. And if there is an event where the probability is fairly small, but the potential payoff is a doubling or tripling of the commodity price, and hence a tenfold escalation in the valuation of some equities, particularly where those equities don't have a lot of downside, in your opinion, that's a pretty good asynchronous bet. And that's really what my interest in platinum and palladium is all about.
Let's shift to the uranium market. Uranium equities having a very decent year as well. The URNM ETF up around 43%, perhaps a little overshadowed by silver's 100% gains, but nonetheless greatly outperforming the broad market. The supply deficit threatens to keep growing, especially as we see the two giants, Kazatomprom and Cameco, along with developers trying to ramp into production, facing challenges. It should also be noted that aside from production issues in the so-called safe jurisdictions, such as Canada, to give the most stark example, permitting times are insane. Government red tape threatens to derail even projects that are on time and on budget. Otherwise, not to mention indigenous groups and needs to make agreements with all of them. Then a new one pops out of the woodwork and asks you for money. All this sorts of stuff happens. So it has its own jurisdictional risk, obviously. The incentive price for bringing production online used to be discussed as around $70 to $80 a pound, which we have now reached. But with everything I've described in mind, has the situation changed? And at the end of the day, where is all this uranium going to come from? This time, Rick, I'll start with you.
Uranium's an interesting subject. Again, I'm starting to sound like a broken record, and both Lobo and I are nodding like sycophants at each other's discussion. But I will say that uranium is no longer hated. I believe that mostly the uranium juniors are fully priced at $75 uranium. It is interesting to me that at $75 uranium, we don't seem to have established an incentive price. I note that neither Kazatomprom nor Cameco has engaged in any substantive development or even restart at $75 uranium, which is interesting. And I note, too, that if you look at the high-quality juniors, a very, very, very small list, their enterprise value relative to the net present value at $75 uranium, given the time it will take them to go into production, they're fully priced. That doesn't mean they can't go higher from a speculative point of view. It also doesn't mean their net present values won't increase. Here's why. In uranium, unlike any other material substance on the planet, we're being freed from the tyranny of the spot market. Producers and consumers can enter into contracts that specify price and volume. If the buyer on the contract is investment grade, not a trading house, it's important to differentiate between the quality of the buyer. Those who can afford to abide by the contract and those who are pretending, that eliminates so much uncertainty for the producer. It allows lazy credit analysts or securities analysts like Rick Rule to not have to worry about spot price projections because they can look at price and terms for 5 years, 10 years, or 20 years. The certainty with regards to net present value estimates among uranium juniors will over the next 5 years become the most certain in the resource space by an order of magnitude, unless contract pricing comes into other commodities. It's a really interesting place to be. And I need to say, in the very near term, and I describe the very near term as a year, none of this matters because most speculators look at the fact that the uranium stocks are up, and that justifies the narrative. They're Geffen goods. The morons would prefer to overpay. Most speculators don't do risk-adjusted net present value calculations. They rely on the dictum, got a hunch, bet a bunch. And most speculators, given how difficult it is to do the sleuth work, to understand the contents of contracts, don't care either. This is the classic juxtaposition between price and value. And in order to pay attention to this game, you have to work hard and you have to have at least a 5-year horizon, which probably means that reality is of interest to 2% of the speculative community.
Lobo, you mentioned you've been purchasing some uranium equities recently that were on a downturn. I'm guessing you're very bullish on the long-term prospects of the sector. Would love to hear your comments on Rick's thoughts and your overall assessment at present of the uranium equities.
Sure, I'll do the bobblehead thing on Rick's very erudite and precise exposition on the opportunity in the space. Let me just add a couple brief points. One, spot's volatile. Two, long-term contract prices up this month.
Yep.
Price versus value. I think there's really not much more that needs to be said. So if the underlying value is increasing and volatility noise on the spot market creates a buying opportunity, I mean, that's pretty obvious to me. I understand that it's possible to make money buying high and selling even higher, the greater fool theory, but I was taught to buy low and sell high. So, for all those people that are mad at me for not giving you, hot tips in gold and silver, well, the fact that there is volatility creating opportunities to buy low, or at least relatively low in the uranium space, that's where my money has gone right now. That doesn't mean I'm bullish on anything else. It means that I look for opportunities to buy low. That's what I do.
I'd like to make one more comment about uranium, if I might, Lobo. And that is to say that when people look at the supply statistics in uranium, they include 75 million pounds of supply that are owned by the Sprott physical uranium.
Oh, I thought you were going to talk about next gen and other things that.
No. I'll pick on them some other time. But when people look at the aggregate supply statistics, in addition to looking at the Japanese supply, which isn't really supply, it's being leased as opposed to sold, they forget to note that 75 million pounds of supply has no sale mechanism in it. That supply has gone to supply heaven, unless a strategic bidder comes in and makes a huge bid way over market for the Sprott Physical Trust, which I don't see happening. The other thing is that this reliance on the spot market is interesting, given that on most days, the dollar volume of the Sprott Physical the SPUT is double the dollar volume on the spot market. The Sprott market has become the tail that wags the dog. And one could argue that the liquidity in the Sprott product is such that small holders of uranium, given that uranium is fairly difficult to hold, you probably don't want to let people hold it in their basement. I think that dominance continues. It's interesting that the spot market, the spot pricing, is still driving the market, when increasingly, because of contracts and because of Sprott, the spot market is becoming a floating anachronism.
All hail the spot price. I'm with you there. So we're in agreement here. I've just laid out my case. It's great when the commodity sector and metals are our favorite minerals. So many of them are riding high or hitting high prices. It's great that you can have a thesis that's so solid. Like right now, the EU just approved today, as we're speaking, they approved Poland's new nuclear power plant. And it just seems like every day there's another bullish headline. And by the way, this isn't paleo or thorium, but these are conventional power plants. At some point in the future, maybe fission comes and eats uranium's lunch or thorium or whatever. But in our investable time frame, all of this news is very bullish for uranium, happens on an almost daily basis. And as Rick was just talking about with the supply side, it's just not keeping up. The two biggest producers that he mentioned, both of them have officially moved their goalposts. And the juniors have either completely failed to build the mine, or they're behind, or they're lowering their ramp up guidance. I mean, there's nobody that I can think of, not one, that has delivered as advertised on the supply side. So extremely bullish. And in that circumstance, for the market to get distracted by, like the dog in the movie with the cone of shame squirrel, right? They get distracted by the spot price, and that creates an opportunity. I think that's fantastic. And especially if you're chomping at the bit on other metals and you don't want to chase them, it's great to have something to buy until the next volatility comes to another sector. So that's my favorite thing about uranium right now, is that it is actually offering volatility as my friend in this space. And yes, generally speaking, most of the stocks are rather on the deep end than the cheap end. But there are some opportunities for people that are willing to do the work and look for them. Let me say one last thing, though. This has become an AI trade, and it shouldn't. It's baseload power. Uranium runs nuclear power plants, so we want to keep airports lit at night and hospitals running 24/7. And this was happening before, ChatGPT came along, or electric cars even, or anything else. So these other use cases are tailwinds. If they go away completely, which they won't, but if they went away completely, you'd still have increased demand for uranium. But if they do maybe not go away, but there's a big scare. If the AI bubble pops on the broader markets, I expect that to whack uranium harder than other things. And copper too, by the way, one of my other favorite metals. Both of those have gotten a big AI tailwind. So if there's a scare right now, as we're speaking, Oracle has started to put a scare into the market on the AI front. If this thing goes into reverse in a big way, I'm not trying to be scary here. I'm saying I think there could be a potential buying opportunity in some of our favorite minerals. And that would be worth keeping some dry powder for.
That's not a scary scenario, Lobo. That would be my Christmas present.
That's
thing,
how we see it, brother. But all people want to hear is it's going to the moon tomorrow.
Yeah, good for them. There are normal and natural victims, Lobo. One other thing on uranium that I think is worth commenting on. In the course of my career, I've been at least on and off a uranium bull for a very, very, very long time. And for most of that period, I felt likely that my picture would be on a post office wall. The world vilified uranium to the extent that you were making money on Hiroshima, Nagasaki, and 3 Mile Island. Now those same morons want to subsidize me. I need to say I felt cleaner when I was being vilified than now when I'm being subsidized. But what it does say is that there is a broader public acceptance for uranium and nuclear energy, which means that for once, the economy will be allowed to do something that it ought to do, which is increase the amount of reliable baseload power. And that is truly, truly, truly bullish. Public opinion in Japan is an example, which went post-Nagasaki over 80% anti-nuclear, is now almost 70% pro-nuclear.
Sorry, do you mean Fukushima? I mean, Fukushima, Nagasaki matters too, but that was a while ago.
No, you're exactly right, Lobo. Thank you.
Sorry.
I'm confusing my catastrophes, which happens at my age, having experienced so many of them. And in the United States, the sea change has been equally dramatic, from widespread public antipathy to the fact that the Trump administration seems to be willing to provide some number like $100 billion in credit to the domestic power industry and the domestic uranium industry. While I'm philosophically opposed to that, people in the mining industry thrive on dumb money. And there's no dumber money in the world than government. And they seem to be prepared to throw it at me through a snowblower. And I guess reluctantly, I'm prepared to accept it.
Lobo, tell us about the independent speculator.
All right. Well, yeah, I have a free weekly letter. It's called The Digest, short for Speculators Digest. You may or may not agree with me raining on the parade all the time. But I can promise you that if you sign up, we will not spam you with a flood of advertisements. I hate that. check it out, and you can see about the rest of my work through that free offering.
Great. I'll put a link to the independentspeculator.com in the description. Rick, tell us about Rule Investment Media and Battle Bank.
Rule Investment Media is a company that currently provides free investor education with a naked view to building large enough audiences that ultimately we can monetize them. We also put on every 90 days very deep dive educational product called boot camps for which we charge. And we have a high net worth natural resources investor symposium every year in Boca Raton. What Rule Investment Media does is of the most immediate interest is that for anybody who submits their natural resource portfolio to us, we rank that portfolio for free. 1 to 10, 1 being best, 10 being worst, and we offer individual comments on stocks that we think where we might have value. We also have something called the Rule Classroom, where there's over 300 hours of instructional programming for free. We do have a paywalled product there too. And my favorite product that I have is a bank, no longer an organization, a bank that is actually a bank, Battle Bank. To the extent that any of your listeners might be unhappy with their current bank, I suspect that's 100% of your listeners. I would propose that you check out Battle Bank. Among other things, we pay interest, including on your checking account. Interested in interest? You should be. Check out Battle Bank. We allow you to save in 20 different currencies, not just the US dollar. If you're an American, your current bank gives you the following choices: the US dollar, the US dollar, and the US dollar. We give you 20 choices. In addition to that, should you want access to credit secured by your bullion, gold, silver, or platinum and palladium, we offer that. Often, gold holders or bullion holders have had so much of their capital tied up in physical precious metals that they missed other opportunities. They didn't want to sell and incur the capital gains tax. In my case, as an example, establishing a credit line secured by your bullion allows you to access that capital in times when there are time-sensitive opportunities without having to sell it. We have also found at Battle Bank, well, I found as a private lender over the years, that people who are prudent enough to save in gold and silver turn out to be wonderful people to loan to. They have this wonderful characteristic from a banker's point of view. They pay you back. It's a community that I love dearly. So if you're unhappy with your current bank, think Battle Bank.
Great. I'll put a link in the description to both Battle Bank and Rule Investment Media. Gentlemen, as always, fantastic conversation. Thank you so much for coming on the show.
Thank you, sir.
Thank you, Jesse.